This lesson will review deductions, itemized versus standard deductions. By the end of this lesson, you will know the difference and be able to help clients determine the best option for them. Let's get started. What is a standard deduction? The standard deduction is a dollar amount that can be deducted from a taxpayer's income based on their filing status. For 2014, the standard deduction for a single tax filer is $6,200. So let's see how this plays out. Meet Mario. Mario earned $32,000 in 2014. He's single, so the standard deduction is $6,200. This will reduce his taxable income to $25,800. Now let's look at itemized deductions. So what are itemized deductions? Well, itemized deductions are qualifying expenses an individual may have that can be deducted from their income, which also lowers their taxable income, similar to the standard deduction. The difference is the expenses have to equal more than the standard deduction to actually have any benefit to the client. Some examples of expenses are medical expenses, donations to charities, or mortgage interest paid. Let's see what this looks like. Let's go back to Mario. Only this time, Mario has expenses that he wants to know if he can itemize. Mario had a mortgage and he paid $6,800 in interest. In addition, he made a $500 contribution to United Way of the Bay Area. Let's do the math. Mario's income was $32,000. He paid $6,800 in mortgage interest and made a $500 donation to United Way. Together, the interest in the donation reduced his taxable income to $24,700. How should Mario file his taxes? We must ask ourselves, what reduced his income the most? And in comparing, you will notice that itemizing his deduction actually reduced his taxable income the most in comparison to taking the standard deduction. Remember, Mario is only an example, and that the standard deduction is set by the IRS every year. For all the information and for the full scope on deductions, be sure to reference Publication 4012 Tab F to learn more.